So good morning, Tanze. My name is Suzanne Trottier. I'm Métis, born and raised in Manitoba. My mom's family is from both the Lake Manitoba First Nation, that's Marie Rose Chihan, and from Ebb and Flow First Nation, which is Alexis Campbell. And so I'm really honored and humbled to be here and thank Chief Leanne for that beautiful opening prayer or welcoming words and acknowledge that we're here in a good way. So, and thank you, Joseph, for opening us up, and to RRI for having us here for this incredible opportunity as the world spins around us in a very uncertain and unpredictable way. So I know fiduciary duty isn't riveting at 9:30 in the morning, so it's tough, but we're going to try and make this, especially in light of everything that's going on with the tariffs, with south of the border, the uncertainty with what's going on with the markets and your publicly traded investments at the moment. I'm really going to try to customize what we're talking about today and make it relevant for what we're living right now. So in terms of fiduciary duty, really, that is when you are acting as a trustee, you're acting for and on behalf of another. So keeping that as your kind of your guiding, your North Star is understanding your role, is that you are acting on behalf of your beneficiaries, typically the First Nation, whether it's all the individual members, typically it's on a collective and undivided basis, as represented by Chief and Council. But at the end of the day, it's the members of your nations for many generations to come. So that's really important to remember that as we go through today as to what your fiduciary duty is. There are certain legal obligations that arise from being a fiduciary. And we're going to talk about where those obligations come from. So that's important to understand that. And in most cases, you cannot delegate. You can't say, oh, well, I hired the investment managers and I didn't know they were going into crypto. There's certain indemnifications, no doubt, in your trust agreements, but it's important to understand the scope and breadth of what your duties, legal duties as a trustee, where they lie. So I think we're gonna just move here. This is just a reminder of how that fiduciary, the trustee obligations are created. So you've got the creation of I'm just gonna move over here. So you've got the creation here of the trust. Typically it's Chief and Council, and typically your trust agreement is likely ratified, right? Generally, that's how it's voted on. So that creates that fiduciary relationship through yourselves as trustees. And so you've got that legal liability coming from the trust agreement, and you're accountable to the beneficiaries. So it's just important to note that legal ownership that you're taking. It's a difference between beneficial ownership. The beneficial ownership lies with the beneficiaries, but the legal obligation to hold the trust property lies with you as trustees. So here's the three sources of where that legal liability, the trustee obligations come from. Number one, first and foremost, is your trust agreement. So knowing your trust agreement and making sure you revisit that regularly, at least on an annual basis, that's really important, because you're understanding, that's your rule book. That's how you must first and foremost implement the trust agreement. Secondly, there's legislation. And I think Chief Joe, you had mentioned the new relationship trust does not fall under the Trustee Act of BC or of any jurisdiction, but generally your trusts And there's probably another case here I'm thinking of as well. I know one of our clients who does not fall under the Trustee Act, but generally your trust would fall under the Trustee Act of BC, the Trustee Act of Saskatchewan, or whichever region your trust is domiciled in. So it's important to understand what those are, what those obligations are under the legislation. We're going to go through that today. And then there's the third source, which is court decisions, known as case law, common law. So it's all prior tribunal and court decisions relating to fiduciary duty, relating to trustee issues that have come to the courts or the tribunals. So then it raises the question, and it has come up in our work, and, you know, so at FNB Trust, and I didn't really talk about what we do, but we've got 36 clients now, First Nations trusts, representing just over $5 billion in client assets. And this comes up very often, which is, well, what takes precedent over, is it the trust agreement? Or are there things in the Trustee Act? And an example would be, and this has come up with one of our clients, it's a type of investment, and they were wanting to invest in, the Chief and Counsel wanted to invest in a first-time fund manager. So they've never done this before. So when we think of fund managers, and Scott Lunny will be talking about some of that, you know, it could be Fiera, it could be Butel Goodman, but this was a first-time fund manager, so there's a lot of risk associated with that, okay? Now, if it's allowed under the trust deed, if that somehow is spelled out, but yet under the Trustee Act of Manitoba or Saskatchewan or BC says, well, the prudent investor rule must prevail, meaning you've got to protect those trust assets. And going with a first-time fund manager can really come up against that notion of your trustee duty to protect the trust assets. And so we're going to talk about diversification, but that's an example of where if it's allowed under the trust deed, then generally that would be allowed. But you'd want to get legal counsel on that advice, which is what we had done in that instance. But there has been a court case, an old one in 1957, which did determine the first duty of the trustee is to follow implicitly the terms of the trust instrument. Secondly, to observe those general principles of trustee law which do not run counter to the express terms of the trust. So that's just so what are the 7, I know you've been on the end of your chairs, what are the 7 duties? So I know you're like, come on, give it to us. So they kind of overlap, right? So we're going to go through each of them. There's duty of care and skill, that the trustees must always act with care and skill, must avoid conflicts of interest, have the duty to be loyal and act honestly and in good faith, the duty to act with an even hand, so impartially across the beneficiaries, duty to refrain from delegation unless it's explicitly allowed in the trust agreement, the duty to account to the beneficiaries, and duty to provide information and report, and that's particularly relating to investments. So I think understanding the duty of care and skill, so that you must act as a trustee with that skill as a person of ordinary prudence would exercise. So keeping in mind your skill levels, experience, and qualifications. So an example of this in today's environment would be, and I'm thinking back to COVID, where there was a client or trustees who had come to us. They were not a trust client of us at the time, and they said, look, our investment consultant, it was in 2022, and the markets had just crashed. And their investments were down about 39%. And so they came to us and asked and said, our investment consultant has advised us to sell 50% of our total investments across the board, just so that we minimize further losses. And so we said, that's, you should probably get a second opinion. We wouldn't recommend it, right? Because we know over time, and showed them the history of the stock indices and bond indices and how over time they will come back. And one of the worst things you can do is panic and sell in a down market, right? And crystallize those losses because they were on paper. So at the time, they were using another trust company of a large bank, and that trustee had even written a memo and said, this is not prudent. You're going against the Trustee Act of the province in which they were operating within, and they went ahead and did it anyways, and they crystallized those losses. So even though they got expert advice, if you're getting other advice on that, it's really about are you operating with that duty of care? And I would have even said, go get another expert opinion and get it in writing. So those are things where if what you're being told maybe just isn't making sense, especially in this environment now where if you've been watching your investments, they're probably down, and it's get that advice from your investment consultants. And if it is something that's not making sense, go and get another second opinion. So. Avoiding conflicts of interest. This comes up all the time. So this is not just because, the trust, the beneficiaries, they're all our family. We know our beneficiaries. That's very difficult, right? So the accusations can be coming around, well, so-and-so got their PCD first, or how come they got a scholarship and my granddaughter didn't get a scholarship? So it's really important. You can't always avoid the conflicts of interest. That's almost impossible, but there's ways where you can minimize them. And that's through creating policies around how PCDs are distributed, how the scholarships, if you're running a scholarship program, for example, to make sure that any potential or perceived conflicts of interest are managed. So it's important on this is just to always keep in mind you are acting on behalf of and for today's generation of your community's members and future generations, right? And so you cannot personally gain at the expense of those beneficiaries. That's how I find it's easy to understand what a conflict of interest. If I'm in a conflict of interest, it's am I personally gaining somehow in this and having to try to assess that? It's always good declaring it right away in a meeting. It doesn't mean necessarily you recuse yourself, because there may be conflicts for everyone around the table. So it's really just about acknowledging those conflicts, minuting it, getting it in writing in your trustee meeting minutes, and having policies in place to manage and ensure that there is a fair process going on. One of the examples were conflicts of interest. Well, you know what? We'll wait. I'm going to wait because we have a case study that I'll go through on that. Well, maybe I'll just say it. There's what we're seeing a lot is sometimes the compensation of trustees, if it's a per meeting basis, can motivate trustees to have more and more meetings. And so what we've found, and that can be a potential or a real conflict of interest, right? Because you want to make sure that the expenses are reasonable in the trust, right? It's at a reasonable level. And so one of the ways to think about minimizing that conflict is to go to an annual retainer that is paid monthly or quarterly. We see anywhere from $6,000 to $10,000 a year, and depending on how much your trust is meeting, if you're running programs, but it's just to think about how can we mitigate certain common instances where a conflict could arise and put yourselves in a position that you might be scrutinized for that. So that's just, we'll talk about that a little bit later in the case study. Yeah. On loyalty and good faith, oops, I think a bullet's missing there. Hold on, what was that last one? Oh, I see, yeah, okay, use confidential information. So it's making sure you're not buying any of the trust property. This is, again, duty of loyalty, because you can buy trust property, sell your own assets to the trust. It just puts you in a conflict position. It would be very difficult to address. So if you're, an example is if you have land and the trust is looking and it's maybe adjacent to your nation, and you happen, or your family happens to own that land, and the nation's looking to buy it through the trust, you'd really need to recuse yourself from that situation. It's a very specific in the Trustee Acts. Using confidential information for personal gain. That's things like the membership list, knowing who's applied for scholarships, who hasn't, just knowing that you've got to keep that confidential, and also understanding what you can and can't share. And we talk about this almost at every meeting with boards of trustees, is what can and can't be shared, and really looking to your trust agreement for any guidance. And if your trust agreement doesn't spell out what can or can't, if it just says make sure that you exercise diligence and keeping information confidential, then draft a policy. Make sure that, or if you need to hire someone or use your corporate or professional or administrative trustee, but we often see policies on sharing information and what can or can't be shared, who can get that information, and in what format. So in one example, last week, Priscilla, who works with FNB Trust, one of our clients, the trustee said we can only share information with members if they come to the office of the trustee. In that instance, we're a corporate trustee, and they cannot remove they wanted to see the GL. And so it was a very concerned citizen. We all have them, that kind of happens. So, but just, the parameters around that, we have a policy on it, just to make sure that everyone understood there was a sign-in sheet and had to leave the cell phone. So that's just an example of how to get clarity on terms in your trust deed if it's not explicitly spelled out. So to act impartially, I think that's pretty self-explanatory. It's just making sure that all the beneficiaries are treated with an even hand. Even doesn't necessarily mean equal. So we've got clients who, if they're paying a monthly or a quarterly payout to members, elders are getting a higher amount, just to recognize that they won't be able to benefit as many years as some of the younger generations. So if that's spelled out in your trust deed, that doesn't mean that you're breaching that fiduciary duty. That's spelled out in your trust deed. And as we saw at the beginning, the trust deed will always take precedence over the trustee acts of your region. So refraining from delegating, this, again, it's if you hire advisors, which normally you would, investment consultants, you might have a professional trustee, auditors, bookkeepers, whatever that looks like, it's just understanding you're ultimately still responsible for those advisors and what they do, and that they must abide by the terms and conditions of the trust agreement. So if there are things like, for example, you don't want your auditor sharing your confidential financial information, for example, and they're bound by standards as well, but just an example of you still have to oversee all the advisors working for the trust. There is an exception. If the duties are not required in the trust deed to be performed personally by the trustees, or there's no way that you could perform that duty. So an example that comes to mind is investment managers, right? We're not gonna go about and start trading in stocks for the trust, obviously. So that's an example where you are delegating that duty. However, you still have to oversee them. You've got the duty to monitor their performance and make sure they stay within the trustee, but also your investment policy statement that we're gonna talk about in a little bit, and more on fiduciary duty as it relates to that. So duty to account. So this was something that came up yesterday, actually, in a member asking to see monthly financial statements of the trust. And is that reasonable? Because that would require a lot more cost to the trust to produce full monthly financial statements, do all the investment reconciliations. And so it was decided, no, we're going to stick to quarterly because that is an unnecessary cost to the trust. So you do have a duty to account and certainly know what is spelled out in the trust deed, right, in your trust agreement. But if it's not clearly spelled out, and we have seen it with clients where sometimes the trust agreement doesn't actually, it just says you're bound, you must report to the beneficiaries, on a regular basis and get an annual audit, but it doesn't actually spell it out. So again, you'd want to draft a policy and approve that as your board of trustees and say, we're going to report whatever it is, a quarterly dashboard, quarterly financial statements, whatever makes the most sense for your trust and its purposes. And then the other thing is expecting to have your accounts ready within a reasonable time of receiving the request. So if it's mid-month or mid-quarter and it's too early, the books haven't been closed, and if it would cost a lot of money to get your bookkeeper to get all that done, then you have your right to say to whoever is asking the information, if it's chief and counsel or the members, that they'll have to wait until whatever date that you're normally producing those financial statements. So providing information, so there's 3 types of information the beneficiary is entitled to. So number 1 is the trust agreement itself. So knowing what the terms and conditions are, the existence. So typically we see trust agreements posted on the members only part of your portal if your nation has that. So that's important to know they have that right. Also, information regarding the accounts and information regarding, now here it is, the exercise of discretion of the trustees. So an example of discretion is those policies that I've been talking about. So for example, the investment policy statement comes to mind. That would be a big one that you'd want to make sure is made available. And any other of the trust policies. Another one is your trustee travel and reimbursement policy. If you have a compensation, your remuneration policy, these are all things that you generally want to, they have the right to understand what that is. Oops. So on what is, I just want to say the formatting's off because I couldn't email the PowerPoint. It was too big, and RRI had to convert it from PDF back to PowerPoint, and obviously the conversion didn't work great. So sorry about that. So I don't think there was another bullet up there. No. Okay, good. Okay, investment information. So there is, the trusts generally always have a specific power for investments, and it does create that obligation to report on the investment performance. So it's your duty as trustees to carry that out. Now, of course, you're going to be relying on your investment consultants, your investment managers. However, you want to make sure that how that report looks, that it's usable and it's relevant to not only yourselves, but your members, right? They need to understand that. So, we've worked quite hard with a number of our investment advisors with our clients. And Scott, I know you work with some of our clients, so don't feel singled out that we've really kind of asked you to be very specific on what we need. Examples of what we ask for is both gross returns and net of fee returns. That's really important because you're paying someone to earn returns, and you want to make sure that after you've deducted those fees, how are they doing against their benchmark? Because you always have the option to go into a passive investment strategy, right? So we'll talk about that in a little bit. Other things is, and maybe I'll ask Priscilla and Kamana, am I missing any of the other specific things that we ask on the investment reporting? By asset class, I guess the value add. So over the benchmark, rather than having to do mental math, we like it when the investment advisors put in a line that says value add over or under, if they're underperforming the benchmark, just that percentage difference net of fees, just makes it easier for you to be able to evaluate the performance of your investment managers on an ongoing basis. And I know by reporting standards, they've got to put in the 4-year rolling average. It's just really good to make sure you're keeping an eye on that long-term performance as well, right? So if they've been underperforming, for two years, that's 8 quarters, you really want to start giving them some, saying, hey, like, when are you going to turn this around? Having that clear timeline for if you need to replace them if they're underperforming the benchmark. I know this is a lot of writing. So this is a case study on an example of a court case. So this is publicly available information. It's related to the Mosquito Grizzly Bears Head Treaty Land Entitlement Trust. Mr. Bird was a trustee. He was also a council member trustee for a 3-year term. And the trustees, there were 5 of them. So they spent $1.7 million to purchase land, which was allowed under the trust agreement. The land cost $343,000. But the acquisition costs were $888,000, and there was an additional $513,000 that was spent in per diems and expenses to the 5 trustees. So that's over $100,000 each in the period of a year. Is that reasonable? That's the first thing that comes to mind, right? It's like, wait a minute, the land was $343,000, they got $513,000, and then there was an additional $888,000 in So it's really sad. This is a sad case because and there's always 2 sides to the story, right? Because I know you're thinking, they were bandits, they took it. They were getting advice from the lawyer who had negotiated the settlement claim. And this is one of those arrangements where the lawyer said, well, you paid me so much money for the settlement negotiation. Now my legal fees are free for the rest of my days. I will provide you, but there was no retainer letter. So the lawyer, and you got to be careful. Anyway, always have a retainer, always have an engagement letter for lawyers, right? Because otherwise they're off the hook. And that's exactly what happened. So the amount of money, the $1.7 million, was set up in the lawyer's trust account, and the trustees were drawing down from that account. The lawyer had to transfer it, so was aware of the money going out. In any event, so they got sued by the members that this was not reasonable. And so it was ruled that they did have a conflict of interest. They put their personal interests before the beneficiaries. They failed to keep proper accounting records and provide it in a timely way to the beneficiaries. They failed to furnish the information to beneficiaries requested and failed to exercise reasonable care and skill. It gets worse. So, anyway, it's bad. So they ended up going to jail. Isn't that terrible? They went to jail, and one died before they got to jail. So they were found guilty of breach of trust, fraud, and theft. And again, so really, really sad story here. For sure there was conflicts. Not acting in good faith, not doing the duty of care and skill. So getting independent expertise, because clearly that lawyer who didn't have an engagement letter, were they really giving advice, or they were just turning a blind eye, right? And they were, going on that. So you can, so as your trustee fiduciary duty, you can be held personally liable. And any assets that you hold, especially if they're off reserve, could be seized if there is found to be a significant gross fraud or gross negligence, which is what happened here. Here's another example. This is Barry versus Canada in 2005. This is just talking about, so what happened in this case is that the trustee didn't get the monies invested fast enough. And so it sat in a bank account, just earning very low rate of interest. And so the court found that the trustee's duty, it does have to make the assets productive, meaning they can't just sit there because that's lost money, right? You've got to get the monies working for the trust for the best interest of the beneficiaries. However, your duty is not to maximize profits, because then if you maximize profits, you could be taking on undue risk. And I know Scott Lunny's going to talk about risk and return later on, so I won't get too much into that, but just understanding that the trustee is rather the duty to act prudently and invest reasonably to make sure that you are protecting the trust monies, right? And fulfilling the purposes of the trust. This one is about getting proper legal advice, expert advice. And so Moran versus Long Plain. And so it was really about a type of investment that the trustees wanted to invest in. And so what the court's rules has said, yes, the trustees are empowered to obtain professional advice and assistance, and there is a duty that the professional advice must be independent and they must be an expert. So if you think back to the example I talked about earlier on during COVID, the trustee the investment consultant was advising the trustees to sell 50% of the investments when they were down almost 40%. It's really about getting a second opinion on that. Just so you know, that investment advisor was a basement Bob. He was not with a firm. He kind of, yeah. And so you have to be careful, right? Because you want to make sure that the advice that you're getting is sound. Because ultimately, even if you act on that advice, you could still be held liable if the advice is not reasonable and doesn't align with your obligations as a trustee. Now, isn't that fun? I didn't mean to depress everyone. That's not, but I wanted to end with ways on just how do you protect yourselves as trustees, right? To make sure, I don't want to scare everyone, because I mean, we at FNB Trust live with this every single day, right? We're a professional trustee, and certainly I think what allows me to sleep at night is all of the things around making sure that we do have the paper trail. We've got the policies in place. We get expert opinions, even beyond ourselves, because we're CPAs, I'm a CFA, that's not enough. And we have lawyers, but sometimes we even get external lawyers who specialize in a very specific issue to make sure that we're getting the proper advice. This is really just talking about that skill and care, duty and care of an ordinary business person in managing their own affairs. Know that if you do have a professional trustee, it's very likely that we're held, like we're a professional trustee, so we're held to a higher kind of standard because it's really based on your experience and skill. But again, if you're not sure on the advice that you're being given, whether it's from your professional trustee or lawyers or investment advisors, investment managers, go seek second opinions. So just your trust deed, it again goes back to why it's important to know your trust deed, is knowing if there's liability on trust contracts. We talked about the investment manager contracts, but understanding if there's any indemnities provided in your trust deed. Usually there are, to a certain extent. Is there liability for defaults of co-trustees? So there is something if you've got a co-trustee who is maybe not acting in the best interest of the beneficiaries and you can't get them in line, and maybe if you can't somehow, if the provisions for getting them to understand their fiduciary duty, then you may have to resign. I mean, that's something if there is no indemnity for a co-trustee, for the acts of co-trustees. No liability if the trustees are acting in good faith. And there's lots of instances where trustees go ahead and make decisions It turns out in 2020 hindsight, maybe it wasn't the best decision, but if you've done all that you could in terms of getting advice, taking the due diligence and care and deliberation in making those decisions and documenting them, generally you'll be okay. You can purchase insurance, directors and officers insurance. We've talked about that with a lot of our trust clients. It is getting more and more expensive. And as soon as you have a claim, especially if there's a frivolous claim against the trustees, if it's a heated political environment or whatnot, that'll drive your premiums up. So another way to think about protecting yourselves is an indemnity agreement for the trustees that will bind future trustees to pay for your legal costs once you're no longer a trustee, because just because you're not a current sitting trustee, it doesn't mean your fiduciary duty ends. For the decisions that were made while you were a trustee, you will be responsible for that into the future. But you want to make sure that future trustees don't have the ability to say, Suzanne, I don't like your face. I'm not going to pay for your legal fees when you were a trustee. And it's like, so you can get an indemnity agreement drafted, and we've done that with a number of our trust clients as well. And it's a form of self-insuring. If your trust has the ability to self-insure, and if there's no provisions in the trust that prevent that, that's something I would encourage you to think about. So how do you continue to protect yourself in terms of good governance? Be knowledgeable and informed, so know about what's going on that could affect your trust, right? So example, what's going on with the tariffs, understanding, talking to your investment advisors, talking to the investment managers. I know we held some meetings with our clients yesterday, and that was exactly the conversations that went on, was we need to talk to our investment advisors, know what is the strategy, we want to make sure we're protecting those trust assets, right? Attend the meetings as much as you can. You're supposed to actually attend all of your trustee meetings, so make sure they're scheduled out so you can plan for them. Reading the materials, getting the materials with enough advance notice that you can read them. So if you're getting them the night before, if you have a professional trustee and you get your investment consultant's report the night before, you want to fix that, because that's not enough time for you to read it in advance. We've talked about getting professional advice, regularly assessing the performance of your external advisors. That's something that's really important, looking at their fees, right? Because are you getting value for money? And are they performing to what they're supposed to be? Here's something we often find is when investment managers are underperforming, and I know, Scott, it's not you, but anyways, as other investment advisors will try to downplay that. And they'll say, oh, but look, we earned 17% this last year. And it's like, yeah, but the markets did like 32%. The benchmark was, double that. And so it's important for you, and that's why how the reports are displaying the information makes it easy for you to say, well, wait a minute, they're actually underperforming by 13%, their benchmark. So it's great we got 17%. No one's going to complain about that, but we paid them to earn more than what I could have gotten if I invested in a passive index, like say the US market. So just making sure that you're understanding what is that performance standard that you're comparing those investment managers to. Avoiding groupthink. Never want to hear, well, I'm going to vote in favor because so-and-so other trustee is voting in favor. Never want to say that. You always have to have your own voice, because it's important. It counts. You know your community. You know what you know, and you probably know things that are different than other people. So use that voice, right? It's super important. And if someone's putting you at risk, well, I always say then, if you can't work it out, then resign. You just don't want to put yourself at such risk if you think that there's decisions being made that are counter to acting in the best interest of the beneficiaries, and you can't change anyone's mind. Then unfortunately, we have seen, folks, they weren't our clients, but I've had people call me and ask me what to do, and I said, yeah, you're probably best to resign. So it is it is something that you're doing part-time. I know you all have other things that you do in life. You're not just a trustee, right? I'm sure you've got jobs, you've got other responsibilities, other boards. But it is a full-time responsibility, especially in the volatility happening. If you have to have an ad hoc trustees meeting because things are going sideways and you want to talk to your investment advisor to make sure that the investment strategy is sound, which it should be for the volatile times that we're in, but just know that you've got that ability to do that. Talked about using your voice because your opinion really does count. And here's examples of policies if there are gray areas in your trust agreement. So we'll talk about the investment policy statement, key calculations if you have inflation protection hedges that have to be in place to protect the trust capital, how you're calculating that. If it's not spelled out in the trust agreement, you want to make sure you get a policy on that. Documented the interest that's paid on minors' PCDs when they come of age. If that's not spelled out in the trust agreement, often we see it just says, and interest earned. So if that's not spelled out, you're gonna wanna put that into how do you come up with that calculation and document it. We talked about trustee expenses, honoraria, training requirements. So that's important too. Every year, we do a training plan with our clients to make sure if you've got, like for example, this summit, this conference, a great way to keep yourself current in terms of your duty of care and the standard of care. And if the meeting practices aren't spelled out in terms of should there be a chair, should there be a vice chair, what is quorum of your trustees meetings, if that's not spelled out in your trust deed, then make sure you've got a policy on that as well. If you're a new trustees, because I know I've spoken to some of you are fairly new to being a trustee, make sure you get the last 5 years of the financial statements, ideally if they're audited, so you understand and you sit down with either your professional trustee or even the auditor to understand the performance, looking through the past investment management reports, and asking a lot of questions is always key. Your budget, you should always have an annual trust operating budget, right? That's approved by the trustees, and making sure that you understand what that is and it's detailed enough that you know and you can keep track as the year moves on, at least quarterly, whether you're on track with your spending. So I think Joseph, we're at time. I think you have the printouts for the investment policy statement. We've talked about the benchmark. We've talked about types of investments. Chief Leanne, from the question on what about your own investments, what is the level of desired diversification that you want to make sure that if something goes down, if the stock markets go down, you've still got real estate, agriculture, other types of investments to offset that. How rebalancing is going to happen, that's important, right? If you've got multiple managers, if one is outperforming and now you're outside of your allowable range, what is the process to do that? I think most importantly, and what Scott's going to be talking about, is defining your return and your risk parameters. And I think, Chief Joe, your point on what is return? Is it just financial return? Is it other? And again, keeping in mind the trust deed ideally sets out that there's other allowable measures of impact, right? Because I agree, jobs is a big one. The ability for that future wealth generation and capacity building. So it's not just the pure financial return, but again, you want to make sure your trust deed is clear on that. And if not, your investment policy statement, but you got to be careful with the Trustee Act. It's balanced, right? It's all balanced. You're going to have that balanced approach to protecting and growing reasonably the trust assets. And I think that was, there's a lot in here, but we've talked about all of this. Just be mindful not to get too chummy too with your investment. Trust me, that happens. And they're really great people. They're super nice. And so but you have to be able to terminate them. You have to be able to objectively evaluate the performance of your advisors, including your trustee, right? So as much as you love them and your advisors, but you have to be able to objectively evaluate them and make changes if necessary. So just, yeah, thank you very much, and I'm going to be around for the rest of the day if there's any questions. Thank you, Jill. Thank you.